Welcome back to Iron Financial. This is the channel where we cut straight through market weakness to help you forge a significantly stronger, much more durable portfolio. Today we are absolutely putting on our hard hats because we're digging incredibly deep into a legacy retailer that honestly, many people on Wall Street had completely written off and left for dead. We're talking about Victoria's Secret & Co., ticker symbol VCO. I am your lead analyst, and today we're breaking down their shockingly strong Q1 2026 earnings explainer. Look, if you want to keep forging real yield in what is undeniably a highly volatile market right now, make sure you hit that subscribe button right now. Because today we are looking at a company that just delivered a massive, totally undeniable earnings beat across the board. They are actively proving to the entire market that they might actually have the heavy machinery, the intense management discipline, and the sheer capital required to fundamentally rebuild their intrinsic value entirely from the ground up.
Okay, look, I definitely hear the enthusiasm in your voice, but as the market skeptic, I have to step in here right out of the gate. We represent the cautious retail investor, and let's be honest, we have all been burned by these supposed turnaround stories before. The stock market is absolutely littered with legacy companies that somehow manage to string together one or maybe two decent quarters, dress it all up with some very clever accounting or aggressive short-term cost-cutting, and then the whole structure just completely collapses under the weight of weak consumer demand. So the absolute primary question we have to answer for our viewers today is incredibly simple. Is this hype or is it real? Does this Victoria's Secret turnaround have actual structural integrity, or are we just looking at a temporary painted-on facade that's masking a fundamentally crumbling foundation?
Well, I completely appreciate the skepticism, I really do. But the financial metrics do not lie, and right now, they are laying down a bedrock of pure cash. 153%. Just let that number sink in for a second. That is the massive Q1 2026 adjusted operating income growth number that management just slammed onto the table. They generated $80 million in adjusted operating income, which is up an absolutely astonishing 153% from the $32 million they posted in the exact same quarter last year. Think about the current macroeconomic headwinds we are all staring down. We've got persistent consumer softness, inflation that just refuses to quit, and high interest rates. You simply do not accidentally grow your operating income by triple digits in this kind of brutal economic weather unless your turnaround strategy is actually forging a much stronger, much more resilient enterprise. They're stripping out the internal inefficiencies and pouring some very solid concrete. So let's get right into the numbers. Welcome to our first core segment, the drill down. Revenue heat. We are going straight to the income statement to directly compare the architectural blueprints the company laid out 3 months ago with the actual, tangible execution they just delivered. And guys, this is what we call a massive structural beat. Original guidance for net sales was hovering between $1.49 and $1.525 billion. They completely blew past their own construction timelines and delivered $1.56 billion. That translates to a rock-solid 15% top-line increase year over year. But you know me, I am always looking for the real leverage, the real structural steel in this business, and you find that on the bottom line. Management originally guided for $32 to $42 million in adjusted operating income. Instead, they delivered $80 million. That is practically double the absolute high end of their own projections.
Okay, I see the magnitude of the beat. That kind of outperformance is undeniably impressive, but my question is, how exactly did they build this? Did they just slash operational costs to the bone, fire a bunch of staff, and starve the business just to manufacture a short-term margin bump? Or is there actual organic top-line demand driving this expansion? I really need to understand the underlying mechanics behind this revenue heat before I buy in.
They built it with highly durable momentum, and they actually have the institutional confidence to prove it to the market. Take a really hard look at their full-year 2026 guidance raise. They bumped their projected sales up to a new range of $7.03 to $7.13 billion. But much more importantly, they took full-year operating income from a previous ceiling of $460 million all the way up to a brand new range of $550 to $580 million. Market Skeptic. Okay, a guidance raise of that massive size is a remarkably strong signal. I will definitely admit that. Raising full-year operating income guidance by $120 million at the midpoint shows some very serious management conviction. They aren't just crossing their fingers and hoping for a good year, they are fundamentally underwriting it. But the real question still remains for me. Can they actually sustain this heat? What happens when consumer discretionary spending inevitably cools off in the back half of the year? The sustainability of this turnaround comes directly from exactly how they are selling their inventory, not just what they are selling. As CEO Hillary super explicitly noted, the absolute crucial point here is the phrase increased regular price selling. This entire margin expansion is built on what management is calling a promo detox. Historically, we all know this brand relied incredibly heavily on cheap discounts, endless clearance bins, and margin-crushing sales events just to drive basic foot traffic. But not anymore. They are systematically reducing those promotions, which actually drove their average unit retail, or AUR, up in the mid-single digits for the quarter. Listen, when you can sell more physical volume at full retail price, your profit margins expand exponentially, and you simultaneously protect your long-term brand equity. That is high-grade structural steel for any retail income statement.
I'll concede that a promo detox is the exact right long-term play for true brand survival. And digging into the earnings call transcripts myself, there are definitely a few bright spots that show real, sticky consumer engagement. They noted that historically, their Valentine's Day performance has been notably weak. In fact, one analyst correctly pointed out on the call that it's been nearly a decade since they had a truly great one. But this year, Valentine's Day actually delivered the goods. Furthermore, their app downloads were up an incredible 50%. And look, in modern retail, your mobile app engagement acts as the absolute bedrock for your digital traffic. Think about the lifetime value of a digital customer who willingly puts your brand's app right on their phone's home screen. You aren't constantly paying for wildly expensive customer acquisition or relying on totally unpredictable social media algorithms just to reach them. You own the distribution outright. You can send push notifications directly to their pockets. That dramatically lowers your marketing spend and builds a much more solid foundation for recurring revenue.
Exactly. That's how you build a moat. Now, let's shift our gears from the income statement over to the balance sheet. Welcome to Segment 2, the drill down, balance sheet blueprint.
Look, income statements and quarterly earnings can occasionally be manipulated with clever accounting tricks, but cash flow absolutely does not lie. We need to critically examine this company's financial armor to see if they can actually withstand future macroeconomic shocks. Over the last few years, Victoria's Secret has engineered a massive, highly disciplined deleveraging cycle. They took their debt-to-equity ratio from a highly leveraged, frankly dangerous 4.8 times in fiscal year 23 all the way down to a very manageable, totally healthy 1.1 times in fiscal year 26. By aggressively paying down their debt and slashing their leverage, they have significantly repaired the underlying balance sheet. They are actively stripping away the heavy interest burden that was dragging down their free cash flow, giving the company crucial liquidity to continually reinvest in the brand. That is exactly how you build an unshakable corporate fortress. And it is not just about debt reduction either. It is about sheer, unadulterated cash accumulation. Their cash reserves have absolutely exploded from a very modest $132 million all the way up to a massive war chest of $518 million. They are aggressively hoarding cash to create a massive financial safety net.
Yeah, I have to give credit exactly where it's due here. Seeing a legacy retailer's cash position jump to over $500 million while simultaneously bringing their debt levels down is a serious, undeniable structural upgrade. They generated nearly $500 million in operating cash flow in FY26, yielding a pure free cash flow of $312 million. That depreciation and working capital discipline is successfully cushioning the entire margin profile. I can't argue with the math. The balance sheet repair is very real.
Let's actually verify that directly with the source material right now. The actual consolidated balance sheet completely verifies their Q1 2026 asset strength. Cash and cash equivalents are sitting incredibly healthy. But much more importantly, for anyone who seriously studies the retail sector, we have to talk about their inventory management. Total inventories were up only 5% year over year. That is significantly lower than their own prior guidance, which originally projected high single-digit inventory growth. Think about that. They achieved massive 15% top-line sales outperformance without bloating their warehouses with a bunch of unsold goods. In the retail sector, growing your revenue while keeping your inventory essentially flat is the holy grail. It proves deeply disciplined execution, and it means they won't be forced into massive clearance markdowns next quarter just to clear out stale product. They are turning over product highly efficiently and keeping their supply chain completely optimized.
And what are they actually doing with all of this newly generated free cash flow? They are directly rewarding their shareholders. The company executed a massive $100 million in share repurchases in the first quarter alone, buying back roughly 2.2 million shares at an average price of $45.27. Returning capital directly to shareholders while simultaneously paying down debt and hoarding cash shows supreme, unwavering confidence from the management team. They are explicitly signaling to the broader market that they genuinely believe their own equity is significantly undervalued, and they are using their financial muscle to compound earnings per share for the loyal investors who stick around for the ride.
All right. Enough of the victory lap.
I am officially taking the wheel for our third segment, the drill down, tariff headwinds.
As the market skeptic, my entire job is to look for the hidden cracks in the armor. And right now, the biggest potential wrecking ball swinging toward this company's foundation is macroeconomic trade policy. We absolutely cannot ignore the external structural threats hanging out there. Let's interrogate the real data for a second. Victoria's Secret had a phenomenal Q1, yes. But $14 million of that gross profit beat actually came from a highly favorable Section 122 tariff rate sitting at just 10%. That single provision added 90 basis points to their margin, meaning nearly a full % of pure profit on every dollar was essentially a temporary government gift, and that benefit is officially set to expire. Once it does, tariff rates are expected to violently snap back to 20%, add in a projected 30 basis points of ongoing global freight headwinds, and the negative calendar shift of the massive Pink Friday sales event completely out of Q2 and into Q3, and you have incredibly heavy structural threats weighing very heavily on the back half of the year.
You bring up totally valid, mathematically sound headwinds, I won't deny that. But let me counter that with exactly how management is proactively reinforcing the structure to handle the weight. CFO Scott Sekella explicitly stated on the call that they are already assuming tariff rates return to that punishing 20% level through the remainder of the year. They have aggressively baked the absolute worst-case scenario directly into their financial modeling. And remember, even with that brutal 20% tariff headwind and those 30 basis points of global freight costs fully calculated and absorbed into the back half of the year, they still raised their full-year guidance by $120 million on the bottom line. That tells us right there that the underlying core business outperformance is undeniably strong enough to completely swallow the tariff damage and still generate serious growth.
Let's talk about where that specific outperformance is actually coming from, though, because the geographic breakdown really matters here. International sales surged a massive 44.9% in Q1, heavily driven by their aggressive joint ventures over in China. Meanwhile, North American domestic store growth was solid, sure, but much lower at 11.3%. My primary concern as an investor is whether the domestic U.S. market can actually hold up its end of the construction. If the broader intimates market in the U.S. stalls out due to a consumer recession, can international growth alone truly support these aggressively raised guidance targets? Management noted incredibly strong domestic performance in March and April, a period they coined Marpril, but we need to see if that normalizes or if it outright retreats in the coming months.
It is time to bring this all together. Welcome to our final segment, The Verdict, Trap or Opportunity.
Lead analyst. We have rigorously examined the massive Q1 revenue beat, the cash-rich balance sheet, the aggressive share buybacks, and those heavily looming tariff headwinds. Now we converge to deliver our final, no-nonsense summary. From my perspective as lead analyst, the turnaround has serious, totally undeniable structural integrity. It is firmly built on three very solid pillars. Number one, the promo detox has successfully executed. They are driving double-digit sales growth with higher regular price selling, totally abandoning the cheap discount drug. Number two, the balance sheet is deeply repaired. They slashed their dangerous debt levels and built a $500 million cash fortress. Number three, tariffs are navigated. They raised their full-year profit guidance despite modeling for the absolute maximum tariff and freight headwinds. Look, this isn't hype. This is heavy lifting, incredible operational discipline, and exceptional financial execution.
You know, I will fully admit my natural skepticism has been seriously challenged today. The top-line growth, the extremely positive comparable store sales across Victoria's Secret, Pink, and Beauty, and the massive 290 basis points of gross margin expansion expected in Q2, these are real, highly tangible metrics that you simply can't fake. The fundamental repair of the balance sheet gives them the critical liquidity they need to survive inevitable future mistakes. However, smart investors still need to critically weigh that fortified balance sheet against the back-half macro risks. Tariff snapping back, rising global freight costs, and the overall consumer health in what is undeniably a highly volatile economy are sheer forces of nature. And those forces can rattle even the absolute strongest financial foundations.
And that brings us to our final ultimate question for you, the viewer. Trap or opportunity? Are you looking at a perfectly executed retail turnaround forging a highly profitable path to long-term yield, or do you still see fatal cracks hiding in the macroeconomic foundation? We really want to know, so let us know what you think down in the comments. If you gain real value from this deep dive explainer, make sure you hit that like button and most importantly, subscribe to Iron Financial so we can keep helping you cut through the market noise, analyze the hard data, and forge a significantly stronger portfolio. Until next time, stay disciplined, always manage your risk, and keep building.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.